All right, so chapter two really starts a deep dive into how we handle investing in equity securities because our sort of goal at the end of chapter two is to begin to understand how to consolidate companies when the consolidation occurs, not through net assets, but through purchasing the target's equity shares and purchasing over 50% so as to enact what we would call a controlling relationship. So we want to look at each of these pieces, each of the thresholds of ownership, in order to determine what the appropriate accounting treatment is. Basically, our accounting treatment when we invest in the equity securities of another company depends on the amount of influence that the investor or the acquirer has after they purchase the investment ownership in the investee company. So if the transaction happens and we buy less than 20% of the target equity, we invest and only have less than 20% ownership in our investee, then we believe there to be no significant influence and no significant influence in terms of are we able to vote our representatives or our favored leaders into positions of power within the company? Are we able to exert and leverage our controllership of a certain number of shares um, as influence? If you own less than 20% of the company, it's just not likely to be so. And through this, we enact the fair value method. This is a sort of a method for in terms of an investor. We're looking at our investment as a pure investor where we do not own enough to really consider ourselves an owner. Really, what we are interested in accounting for in this case are any gains or losses in the fair value of the shares. So we are almost, you can think of it in an extreme way as a day trader, right? The reason why day traders want to buy equity shares is so they can jump in at a stock at, say, a price of $15 per share, and then turn around and sell it when there is a price increase from, say, $15 to $17. And then they would be able to recognize a profit of $2 per share. And because of that perspective, because of the return we're looking for when we're invested in this level of ownership in our investee, then we really want to track these gains and losses just in the fair value of shares. And, to be more specific and explicit, basically, when we're talking about the fair value of the shares, we're talking about swings in market prices. So that's going to dictate our accounting in that context. Now, if we're moving into a threshold of ownership that is greater than 20, but still less than 50. We don't have majority ownership, but we do have quite a lot of clout in our investee company. We probably are able to negotiate. We're probably able to have some influence over the operations of the company through electing leaders to the board of directors. And in this case, we take a view in terms of accountants that the investee now has significant influence and should use the what we call the equity method. In the equity method, there is some control or influence, but not control. And because of this, we take more of an ownership perspective in the accounting for this investment, which means that we're no longer interested in the swings in market prices for the company that we've invested in. Rather, in this case, with the ownership perspective, we value the investment um, through net income and dividends. So we have so many shares, it's not likely that we're just seeking a $2 appreciation in the price on the stock market per share. Rather, we're in this for the long haul. In the case of owning more than 50% of the company, this is when we enact consolidation procedures. So we're going to look at each type and we're going to look at the accounting entries behind each type. The first module of notes, the first part of these notes for chapter two is going to look at the insignificant influence and the significant influence. And then the second part of the notes will talk about control and consolidation. So the first piece, the fair value method, which is linked to the no significant control. This is where we are recognizing the value of the security on the investor's balance sheet in terms of the fair value of the equity. And we're taking this whole day trader approach to our valuation of that investment. So how do we record that? Now, it used to be the case that we could put some equity into available for sale securities. This is still possible under IFRS, but not GAAP. Not, I should say, US GAAP, because there's other types of GAAP across the globe, but it's not under US GAAP allowable. I don't want to just totally cross it out because again, it is possible under IFRS, but trading securities are the classification, are just the de facto classification for US GAAP. We purchase, we record at cost. We recognize dividend revenue as non-operating revenue, and I should be clear that this is on the income statement because on the statement of cash flows, it can be operating considered dividends. The cash paid from dividends can be considered operating or investing, but on the income statement, it is definitely non-operating. When we have to show these swings in value, these gains and losses, and we want to value our investment through those gains and losses, we use a security fair value adjustment account, which is a real account. It's also an adjunct account. You should have covered this really in intermediate two, but we're going to take a small review of it. It's an adjunct asset account that is tied to the investment account. Now, we recorded the investment at cost, and we're going to keep it at cost up until the day of sale. And we're going to record the swings in fair value, those price increases in the shares of stock or the price decreases in the shares of stock over time as um, through this mark-to-market adjunct asset account. The unrealized gains and losses from a trading security do affect net income. So they do end up in the income statement prior to the disclosure of net income as a subtotal. And that's in opposition to if we were to record it as an available for sale security. Available for sale securities, even under US GAAP, we do still have, just to remind yourself, we do still have available for sale under GAAP, but when I say it's not possible under GAAP, I'm talking about it's not possible for equity securities. We still do have debt securities that can be available for sale, but this table is really just in particular talking about equity security ownership because we're talking about no significant influence. What are the rule of thumb is less than 20%. This is all about equity securities. But under IFRS, if these equity securities are classified as AFS, then we would take that through OCI. And then finally, when we sell the investment, we just debit the amount that we got at the point of sale. We credit the investment at historical cost, HC, because that's what we recorded the initial account at. And then we record a gain or a loss based on the difference between what we bought it at and what we sold it at. And if there was any unrealized amount left in the adjunct asset account, we need to reverse and zero the security, oops, fair value adjustment account. So let's talk about the financial statement effects of these pieces here. Balance sheet effects. Equity securities are recorded at fair market value since they're all being recorded as trading securities. As I mentioned, only the only classification available for equity securities is trading under US GAAP. For income statements effects, very similar to debt securities, those changes in fair value of the equity securities have what we call those unrealized holding gains and losses, and they are disclosed as effects to net income. Any dividend revenue is recorded in net income. Just remember, this is not dividends we're paying to our shareholders. These are dividends we're being paid as shareholders of another company, and that is non-operating income, or another name for this section. I like to call it non-operating because it seems a little bit more on the nose, but in practice, most companies call this other income on the income statement. And when equity securities are sold, we have a realized gain or loss, and that's disclosed on the income statement as well as a non-operating effect to net income. So their unrealized losses are the and another non-operating or other income effect. Dividend revenue is recorded as other income, and then finally, when we sell, that's recorded as non-operating or other income. Okay. The statement of cash flow effects for these things overall. So this is a little different, and we're just talking exclusively about trading securities at this point. But when we purchase equity, we are going to classify that as an operating cash flow because this is a trading security. Now, if this were an AFS or an HTM security, we would record those as investing cash flows, but trading securities are recorded on the statement of cash flows as operating cash flows. So that's a distinction between what we show on the income statement and what we show on the statement of cash flows. If we have any gains or losses, okay, and then remember, as a backdrop, we're recording our purchase, how much money we spent at the initial, and the sale, how much we got when we sold. All of those cash flows in and out are being recorded as operating cash flows. So the gains and losses over time, right? Those are masking or adding noise to our net income. Because if I'm just recording the cash in and out from the purchase and the sale, those gains and losses are embedding themselves in net income because they are all non-operating activities that affect net income. And if we don't back out those gains and losses, we'll effectively double count some of the cash from the purchase and the sell. So we need to reverse the realized gains and losses as well as any unrealized gains and losses over time. We're going to reverse that from operating activities. And the reason why we have to do that is we're most likely using the indirect method of the statement of cash flow to derive our operating cash flows. And remember, with the indirect method, we start at net income and then we derive basically cash flow from operations by a process here of stripping all accruals, I should say, and it's going to be hard right here, non-cash accruals from net income. So we're moving from a figure that contains those unrealized gains and losses or those realized gains and losses on sale to a measure that just records the amounts of cash that we received or spent. And the way that we do that is taking out the accruals that we recorded over time that don't necessarily reflect a cash event or might double count a cash event. Dividends can be a little harder simply because the dividend revenue, and again, remember, we're talking about the dividends that we receive as an owner of the company, not the dividends we pay our shareholders. This dividend revenue can be classified either as investment cash flows or operating cash flows. And if we want to classify these as operating cash flows, then we're fine. We don't have to reverse any cash flows because the journal entry would increase cash and net income by the same amount. What I mean by this is since we're increasing cash and net income by equivalent amounts, this is not a non-cash accrual. Think about it, and I can write the two journal entries pretty simply. If we record let's say, an unrealized gain of $2 versus we're recording dividend revenue. Oop, yeah, there was a little repetition there. Dividend for $2. The unrealized gain is going to debit security fair value adjustment and also credit unrealized gain. And this is how we would recognize a $2 appreciation in the price of our insignificant influence investment. This increases an asset because it's debiting the adjunct asset account. This increases net income. It's disclosed as a non-operating or other income item. So there's a swing in net income, but there is no cash flow. That's a non-cash accrual, right? Um, that needs to be taken out of net income to figure out true cash flow from operating activities. In the case of recording a dividend, how we would record this is a debit to cash and a credit to dividend revenue for $2 each. Well, in this case, we have a flow to cash and a flow to net income. So this $2 is reported in net income because we credited dividend revenue, but we want it to stay there in cash flow from operating activities if we are classifying it as an operating cash flow. It should be here. And so it is there. We want to keep it there. No adjustment needed. Okay. Here, we're trying to go from net income to cash flow from operations. We have something that is increasing our net income, so it is embedded here. But since there's no cash account here, right? No cash account. Doesn't matter that we're increasing assets. That asset is not cash. And since that entry is not in CFO, there is no cash presence. We want to take this $2 out. We need to reverse it. If we want to classify them as investing activities, then it becomes a little more problematic. Well, it's first what we need to do with this dividend revenue is to recognize that if we want this cash flow to be investing activities, not operating, we have to get rid of this. Uh, we got to get rid of this dividend revenue because it is inside net income. If we don't reverse it, it'll end up being reported in cash flow from operating activities from an indirect method. Then we just need to make sure that we include the $2 in cash flow from investing activities since we took it out of this derivation from net income to cash flow from operating activities.